Hello, everyone, and welcome to Fundamental Auditing, Chapter 6. So Chapter 6 is talking about assessing risks in an audit engagement. This is something you have to do in your planning section. So when doing your audit planning memo, assessing the risks and documenting them is a big part of the audit planning memo. So doing a business risk analysis. An auditor needs to understand the auditee's business risks and what is management's strategy for addressing those risks. So companies can have a lot of business risks, but if management has a good strategy in place to address those risks and to either prevent or detect those risks, then it probably will bring down the risk that there is a material misstatement in the financial statements. So after doing this business analysis in your planning stage, the auditor should be able to determine, is there any weaknesses in the client's risk management process that could lead to a misstatement on the financial statements. So it's kind of like two parts to this business analysis. You want to do a strategic analysis and a business process analysis. So for the strategic analysis, you're going to gain an understanding from the senior management of what the business objectives are, what the key strategies are to meet those objectives, and what are the risks that threaten the achievement of those objectives. So you can get that information from the client, and then you're going to decide if any of those risks could lead to a misstatement in the financial statements. Management will minimize risks by having a good business process. So a business process is the way that they do their operations. So it should be designed to ensure that they are complying with laws and regulations. Looking at IT and e-commerce is also important. So auditor really needs to be able to understand the IT component too, what type of IT systems and everything that they have, because if that's not reliable, then there could lead to misstatements in the financial statements. You're also looking at business performance analysis. What are the performance measures that the employees have? So if performance measures are tied to certain numbers in the financial statements, you want to check to have those numbers, or could those numbers be manipulated by those people in order for them to have like better bonuses. So for example, if net income is tied to bonus, the higher the net income, the higher the bonus for management. If management does have access to creating the financial statements or changing the amounts, then they might inflate the net income number to get a bigger bonus. So looking at, when talking about financial performance, the auditor can look at analytical procedures. They can do a review of management's accounting policy choices. So look at the accounting policy choices that they've chosen against what the industry has chosen. And if their accounting policies are different, so for example, if they're a construction company and they're using completed contract method, but a lot of other companies in the industry are using percentage completion method, then you want to kind of question, why are they using completed contract instead of percentage completion? You want to consider the quality of earnings. So does whatever they're reporting as their earnings, does it actually represent the economic performance of the company, or is it because of the way that they've chosen their accounting policies, or is it because of management manipulation? All right, so management makes assertions about all the accounts in the financial statements. And as auditors, we have to obtain evidence about the assertions made by management in the financial statements. So there's 5 principal assertions that cover the claims that made by management in these financial statements. So management says that the financial statements or the accounts exist, so they have existence, or if you're looking at balance sheet accounts, it's called existence. If you're looking at income statement accounts, it's called occurrence. Management will claim that the accounts are complete, so completeness, ownership or rights and obligations around the assets and liabilities. So they'll say that, yes, we have the rights on our assets and we have our obligations. Valuation or measurement and allocation in the income statement. So Here you're looking at management saying everything is valued correctly or measured correctly, and then presentation or classification and disclosure. So management is claiming that everything is presented correctly, everything is classified in the right accounts, everything that needs to be disclosed is disclosed. So management says that, you know, everything that needs to exist in the financial statements exists in there. Everything is complete. We do have ownership around our assets and liabilities. Everything is valued correctly and everything is presented correctly. So this is what management is saying about their financial statements. And us as auditors need to look at these 5 different assertions and say, okay, what could go wrong? So they're saying the accounts are complete, but what could go wrong to make the accounts not complete? And then the auditor is going to audit these assertions through their audit procedures. So we're going to get evidence around whether the financial statements are complete, or whether the numbers in the financial statements exist, okay, or whether everything is valued properly. So when we're doing our planning activities, we have to look at these 5 assertions and plan out what audit procedures we're going to do in order to gain the evidence that we need to ensure management was correct about these assertions. Okay, so we need to look and think about these assertions and create our audit procedures around these assertions. Okay, so these assertions are really important for you to know and understand, because when you go and do your audit procedures, develop audit procedures, you need to develop them around these assertions. So if you don't understand this, you're not going to be able to do well on your audit planning memo, the section of the audit procedures. All right, so let's go through each of these assertions one by one so you can understand what they all talk about. Okay, so existence talks about the fact that assets, liabilities, and equities actually exist. So the assets that they have listed on their financial statements, do those actually exist? So the company is saying that they have 5 machines as capital assets on their balance sheet. So we need to get evidence to prove that these actually exist. Or if it's a car company, like if they say they have 20 vehicles and 20 vehicles show up as their capital assets, we need to make sure these actually exist and go and get additional evidence. So we can actually go and see them, right? We can physically inspect these 20 cars and say, oh yeah, these 20 cars are here. So that's what existence means. And then the other side of things on the income statement, the assertion is called occurrence. On the balance sheet, it's called existence. Okay, so when you're testing something on the income statement, you're testing for occurrence. You're testing that revenues and expenses have actually occurred as of that proper date. Okay, so because your balance sheet items stay on your financial statements when carried forward to the next year. That's why you're testing existence. But revenue items and expense items, you close off your income statement. So we're just checking not if revenue and expenses exist, that's not the correct word for it, it's whether they have occurred. So have those revenue transactions occurred, have those expense transactions occurred. Okay, so just recognize the difference between when you're testing balance sheet items, you look at the assertion existence. When you're testing revenue and expense items, you look at occurrence. Okay, so it's just a different in wording, but you just want to make sure you distinguish between those two with whatever you're testing. So when you look at your revenue and you look at your general ledger and see all your revenue items, or see all the management's revenue items, you're questioning, have these revenue items actually occurred? Has the revenue actually occurred as of that date? So as of the cutoff date, which is going to be year end. Right? So you're also looking at like cutoff considerations. So you're making sure that no transactions from the next period have been recorded in the current period you're auditing. So you also want to take a look at that. Okay? So revenue and expenses have occurred in that proper period and not the next period. So that's the first one. So you're making sure that things that what management has actually reported actually exist or actually occurred. The next one is completeness. So completeness is basically the opposite of existence and occurrence. So here you're checking everything that management has said or has recorded for these accounts. Are they complete, or is there anything missing? Okay, so have all the transactions and accounts that should have been presented actually included in the financial statements? So is there any items that have been missed? Okay, so you're looking at completeness. Is this all complete, or has anything been missed? So when you look at your liability section, you want to think, when you look at management's liability section, you want to think about, has anything been missed there? Is there a big liability that they haven't recorded because they don't want their liabilities to look too high? So here, so when you're looking at existence, you're looking at whatever they state, whatever they have on their financial statements, does that actually exist? When you're looking at completeness, you're saying, is there anything missing from what they have? Okay. So it's the opposite. So existence and completeness are the opposite of each other. And you're also looking at cutoff considerations here. So you're saying, well, is there any transactions missing that should be included in the current period that are actually included in the next period? When you're looking at completeness, you're looking at whatever they did record, should they have recorded that in the next period instead? All right, so the next one is ownership. So ownership or rights and obligations. So here, this is a balance sheet assertion. Here you're going to get the evidence around that the amounts that the management has reported as assets, do they actually represent the property rights? So when they say they own these buildings, do they actually own those buildings? You need to go and find the purchase and sale agreements and determine whether or not they actually own the assets that they're saying that they own. And then the amounts that they've reported as liabilities, you want to make sure that they represent the obligations that they actually have. Okay, so rights. So when you're looking at ownership, there's two parts to that. Rights is, do they actually have rights to the assets that they say they have? So do they actually own the assets they say they have? And then obligations. So the amounts that they've reported as liabilities, do they actually represent the obligations of the company? So you want to look at, so if they have like like a loan, if they have a bank loan on their books as a liability, you want to check the loan agreement to determine is that actually an obligation that they have. The next one is valuation or measurement and allocation. So here we're determining whether management has reported the proper values, okay, to its assets, liabilities, equities, revenues, and expenses. So here for assets, for example, we want to make sure that inventory is valued correctly, or the assets are valued correctly, or the accumulated depreciation amount, is that valued correctly? So there could be errors in how they calculate depreciation for a certain year. Yeah, so, and equity is like looking at their common shares. Are those valued properly? And then revenues and expenses, are those correct amounts? Are those accurate? So when you're looking at revenue expenses, you usually call it accuracy. So is the revenue supposed to be 500,000 or should it be something else? So for example, if revenue is being calculated using the percentage completion method, you want to check if the percentage completion calculation was done correctly to make sure that revenue is reported at the correct amount. And then the last one is presentation, where you're looking at classification and disclosure. So you're looking at whether the accounting principles were properly selected, are things classified in the right area? So are current assets, is there something putting current assets that should be long-term assets or the other way around? Are there appropriate disclosures in place? So are they missing a disclosure on related party transactions, for example? So you have to audit the disclosures as well as auditing the financial statement numbers to make sure everything is presented correctly. Okay, so those are your 5 assertions. You want to think about the assertions when you're planning the audit, because you want to decide or figure out, okay, so there could be an ownership issue here. So that's how you kind of start developing, okay, what audit procedure are we going to do to test to test ownership? What audit procedure are we going to do to test valuation, to make sure that the proper value has been assigned to these liabilities or assets? And so you always want to think about the assertions and say what could go wrong. So management is saying that everything is presented correctly. Management is saying is everything is disclosed that needs to be disclosed, but what could go wrong there? And then develop an audit procedure to ensure that it's what they said is correct. All right, so another part of the audit planning memo, or the big part of the audit planning memo, is doing an audit risk assessment. Okay, so the audit risk, we've talked about this before, is the probability that an auditor will fail to express a reservation that financial statements are materially misstated. So essentially they'll say that they'll issue an unmodified opinion or a clean opinion and say the financial statements are free of material misstatements, but in reality they're not. Okay, so that's the audit risk. They're gonna provide a wrong opinion. They're gonna say that there's nothing wrong with these financial statements when there actually is. So the audit risk is greater if there is poor planning or poor execution of the audit, right? So if you don't plan properly or if you don't execute the audit properly, then there would be a risk that you are going to miss something and provide a clean opinion when there actually is a material error. Audit risk is inversely proportionate to the risk of getting sued. So if you provide this report, and then later on, the financial statement users or somebody finds out that there were actually material errors, but you provided a clean opinion, that is definitely a big risk of you getting sued because you provided a wrong opinion to the financial statement users. Okay? Audit risk is dependent on user reliance. The more users that are relying on these financial statements, the more sensitive that your audit risk is going to be. Because if you provide an incorrect opinion and there's only one user of the financial statements, only one user is going to be impacted by your wrong report. But if there's many users, then there's a lot of people impacted by it. Audit risk is also implied to individual account balances and disclosures. So you want to look at, what balances are important for the financial statement users, and take a look at, okay, if there is an error in revenue, for example, this could give us a wrong opinion if we don't find it. So when we're looking at audit risk, there's actually an audit risk formula that we have to follow. So when we're doing our audit planning, in our audit planning, we have to go through our audit risk, figure out what the audit risk is, look at all the business risks and everything and translate that to audit risk. So there's 3 parts to audit risk that we need to know. There's something called inherent risk, control risk, and detection risk. Okay, so we need to assess, auditors need to assess the risk based on inherent risk. So what is the inherent risk, what is the control risk, what is the detection risk, and that all makes up audit risk. So there is an audit risk formula that needs to be followed. So audit risk equals inherent risk times control risk times detection risk. Okay, so that's the formula that you would need to know and need to be able to follow. So audit risk occurs when a material misstatement has been made in the transactions or balances, which is inherent risk, and internal controls fail to detect or correct the misstatements, which is control risk. So inherent risk, well, I think we have, we're going to go through these one by one. And then detection risk. Detection risk is the risk that audit procedures will fail to detect the misstatements. So detection risk is, I think I have a slide on that a little bit later. So let me explain these types of risks separately first, and then we'll come back to the formula. So inherent risk. Inherent risk is the probability of material misstatements occurring in the transactions that are entering the accounting system or in the account balances. Okay, so inherent means that this is inherent to the business. Okay, so auditors don't create or control inherent risk. We are going to assess inherent risk based on the business processes, the business risks, whatever's going on, the economy, the industry. Okay, so the inherent risk is basically the risk that's inherent in just doing the business. Okay, so if you're in the business of construction, what are the inherent risks of being in construction that would create you to have misstatements in the financial statements? So auditors try to assess the inherent risk magnitude based on prior experiences, management bias, nature of transactions. They're going to look at the client business, types of transactions, effectiveness of their accountants. So inherent risk is basically what are all the risks that are inherent in the business that could lead to a material misstatement in the financial statements. So if there is, for some examples of inherent risk, is that there's a lot of competition. Okay, so if this industry is very, very competitive, that could lead to management in inflating their revenue numbers to make it look like they are doing great in the competition. Or we talked about how management bonus could be linked to net income. So there is an inherent risk that net income could be inflated because management has a bias to increase net income to increase their bonuses. Okay? Another inherent risk could be that this is a first-time audit. So if it's a first-time audit, then there definitely is a risk that opening balances could have misstatements in them because they've never been audited before. So that would be an inherent risk. So this is not something that people really can control. It's just basically what's going on in the business. If it's a first-time audit, that's nothing that somebody can control. That just means that there is a risk that opening balances will have that may have misstatements. Okay, so inherent risk is any risk that there could be misstatements in the financial statements based on just how the business is run, like just like the industry, the types of transactions, if there's complex transactions. So if it's a really, if there's some really complex transactions, that could increase the risk that there is material misstatements because there could always be errors in complex transactions more than, just really simple transactions. So if the controller is not a CPA, that could increase the risk that there could be material misstatements in the financial statements because they are not, properly qualified to maybe find all the errors in the financial statements. So that's inherent risk. So this is just, so when you this is why you need to gain an understanding of the business, of management, of what type of performance measures are in place, the strategic analysis, business process analysis. This will help you determine what the different inherent risks are. So what you would do is you're going to figure out, these are all, like there's some things that would decrease the inherent risk as well. So you're not just looking at things that increase the inherent risk, you're looking at things that decrease the inherent risk as well. So what you can do when you lay this out on, when you put this is just writing when it's not supposed to. So when you put this in a audit planning memo, so you're gonna have inherent risk, you're gonna look at increases, and you can talk about all the things that increase the risk, right? So 1, 2, 3, like, so we said first-time audit, management might have a bias because their bonuses is based on net income. There could be lots of competition. So you want to write out all the things that would increase inherent risk. Then you want to write out all the things that could decrease inherent risk. So maybe there's like a CPA that is the controller. So that would decrease the risks of material misstatements because the person that's looking at the financial statements is very qualified. This could be an audit that you've done over and over again, and there hasn't been any misstatements in the previous years that you've done the audits, right? So, so no misstatements in previous years. And then you would keep going. So you have things that increase inherent risk, you have things that decrease inherent risk. And at the end, when you do a conclusion, you have to conclude on what the audit risk is. So we need to put a number in this, because when we go and do our audit risk formula, we're going to multiply inherent risk by control risk by detection risk to find out what our audit risk looks like. So we need to put a number here. So after figuring out all the things that increase risk, all the things that decrease risk, then you're going to conclude on whether the risk is high, medium, or low, and what type of number you're putting. So you're going to put a number between 0 and 1. So that's how the risk formula works. So here, if it's really risky, you're going to put a higher number. Okay? So if it's really risky, you're going to put a higher number. So maybe we'll do 0.8 because there's a lot of risks, not too many things that decrease the risks. Or if there's not too many risks and there's a lot of things that decrease the risk, then maybe we'll do 0.05, okay? Because that's not risky at all. So between 0 to 1, depending on your analysis, you would come up with a number. Okay. All right, the next one is control risk. So the control risk is a risk that whatever the internal controls that the company has set, they actually will not work to prevent or detect a material misstatement. And so when looking at the day-to-day operations, there are internal controls that management should be putting in place in order to make sure that in order to prevent material misstatements in the financial statements, or in order to detect material misstatements in the financial statements. And so, so day to day, management should be reviewing the work of the bookkeeper, for example. That could be a control that they have in place. Maybe only a few select people have access to the financial statements. If everybody has access to the financial statements, there's more of a risk that somebody will go in and change something, right? So maybe only 2 people have access to the financial statements. So that could be a control that they have. Segregation of duties is another control that somebody would put in, or a company would put in. So if one person is collecting all the cash from customers, and that same person is recording the cash, and that same person is depositing the cash in the bank, then that person can pocket some of the money, and then not record as much and not deposit as much. So if there's different people doing those 3 activities, there's less of a chance that somebody will steal. So if somebody's collecting the cash, they know how much cash is being collected. They give it to the person that's going to record the cash. If the person that records the cash records less, then the person collecting the cash will know that, wait a minute, why did you record less? It should have been, $1,000. And then the person depositing the cash knows they have to deposit 1,000. Those other 2 people know it's 1,000. So if they take some of that money, the other 2 people will know that they've taken it. And so that's segregation of duties, making different individuals do different things. So there is no one person doing everything and they can steal. That is an internal control. So auditors need to figure out and evaluate what type of controls that the company has in place, and then they're gonna figure out what their control risk amount is. Okay, so they are going to just evaluate and assess the probability of a failure to detect misstatements through the internal controls that the company has set up. So in order to do this, auditors need to study and understand the internal controls of the company in order to be able to do this assessment. Okay, so there are some control frameworks available and to determining how to assess controls. So we're going to look at this more in the next chapter, in chapter 7. So we'll talk more about how you determine what type of controls a company is supposed to have and stuff like that. Okay. So same thing here, you're going to look at control risk. You're going to look at things that increase control risk. So if there is no segregation of duties, if no one's reviewing the bookkeeper's work, so stuff like that, you're going to look at things that decrease. So maybe they do have segregation of duties. Maybe they have a really good internal control, like IT system, that if you record a sale, it also updates the inventory automatically, right? Making sure the same person is not doing a whole bunch of stuff. That means that they can like steal. So you're going to figure out what increases in control risk, what decreases control risk, and then you're going to do a conclusion. You're going to conclude on control risk somewhere between 0 and 1. The higher the control risk, the higher the number is going to be, right? The lower the control risk, the lower the number will be. So you're going to figure out the amount after doing the analysis. So the combination of inherent risk and control risk equals the risk of material misstatement. Okay, so control risk and inherent risk. So control risk times inherent risk, this equals the risk that there could be a material misstatement in the financial statements. Okay, so together, those two create the risk of material misstatement. Sometimes it might be difficult to kind of separate inherent risk and control risk. So maybe an auditor will make a combined assessment of the risk of material misstatements by taking these two into consideration. But basically those two make your risk of material misstatement. The next one is DR, or detection risk. So detection risk is a risk that that the auditors will not be able to detect the material misstatements in the financial statements. Okay, so detection risk is something that the auditor can control. So if there is a risk that they're not going to find an error, a material misstatement in the financial statements, what can they do to decrease this risk? They can do more work, right? So if they think there's a risk that they're not going to find something, then do more work to find it. Do more procedures, do more tests, get more evidence. So if we think that, you know, we might not find if there's a risk that we might not find the errors for revenue, then we'll take more samples of revenue items and test more and figure out. So if our detection risk is something that we can control, so we decide what the detection risk is based on how much work we're going to do. Okay, so the smaller the detection risk, so I'll just write this down. So the lower the detection risk, the more work auditors have to do. So the more evidence auditors have to obtain. So the lower the detection risk, the more evidence we have to obtain. The higher the detection risk, the less evidence we have to obtain. So if there's not really a risk, if there is not too much of a risk that we're not gonna find a material misstatement, then we don't have to do so much work. If there isn't too much of a risk that we're not gonna find something. But if there is a risk that we're not gonna find something, then we wanna make sure we do more work in order to make sure that we find it. Okay, so we'll do some substantive tests, we'll look at account balances, we'll do some analytical procedures, we'll do like a whole bunch of procedures to make sure that we get enough evidence, so then we don't have this risk that we're not going to find any material misstatements. All right, so so let's put this all together now, because we know what inherent risk is, control risk, and detection risk. Okay, so the higher the risk of material misstatement, the higher the inherent risk and control risk will go up. So what we can control, so we can't control inherent risk and control risk. We can control, what we do as auditors, we decide what audit risk we're willing to accept. Okay, so we're going to decide on this. We're going to decide we're only willing to accept a very low audit risk. So if there's a risk, so audit risk is the risk that we're going to issue a wrong opinion. We're going to say everything is good when it's not. Then we have to kind of put in an amount for this. So what audit risk are we willing to accept? Usually in practice, the range that the auditor would be okay with is somewhere around 0.05. So we want it to be very low risk that we're gonna issue a wrong opinion. Okay. So in order to have a really low risk, we can't control these two, but we can control DR. So in order for us to have a low risk of 0.05, we have to input an amount for DR in order to get our AR to be 0.05. Okay, so, and like I said, the lower the detection risk, the more work the audit will require. So this formula helps us determine how much work do we have to do in the audit, right? How risky is this audit and how much work do we have to do? So we can kind of change around the formula for us to figure out the DR, how much work we have to do. Okay, so for example, let's do an example where we put some numbers in, right? So DR is going to equal AR. So AR, we decide. So we decide, you know, we want to have our risk of not issuing a correct opinion very low, because we could get sued, we can get fined, there could be legal issues if we provide a wrong opinion. So we want our audit risk to be as low as possible. Okay, so usually it's around 0.05, maybe 0.1, depending on what the auditor wants. Okay, so in this case, we'll say we don't want our risk to go over 0.05. And then to find out inherent risk and control risk, you're going to do the assessment of the company and figure out what these are. So if we say there's lots of inherent risk, so inherent risk is going to be high, so 0.8, and same thing with control risk. Okay, so 1 is the highest, so 0.8 is pretty high. So when figuring out what detection risk is going to be, we'll do this, and this will give us 0.08. So if 1 is the highest, 0.08 is pretty low. So the lower the detection risk, the more work we'll have to do. So we're going to have to do a lot of work on this audit in order to get us our audit risk to be 0.05. Okay, so we're going to have to do a lot of work, get a lot of evidence in order to be okay with the 0.05 audit risk. Let's try another example, something that's not as risky. Okay, so let's say that this is a good company, there isn't too many inherent and control risk, so we want 0.05 as our audit risk. So if a question or something doesn't tell you what the audit risk is, assume it's 0.05. So we'll say that, you know, inherent risk is medium, so we're going to say inherent risk is 0.5. Okay. And they do have a lot of controls in place in order to prevent and detect misstatements. So we'll say control risk is pretty low at 0.2. So if we do the calculation there, we'll have a detection risk of 0.5. So that is a lot higher than 0.08. So we don't have to do as much work for this audit than we would for this for the 0.08 audit. So we can reduce our audit work because there isn't as many risks in this company that there's going to be a material misstatement in the financial statements. Okay, so we have to do this analysis to figure out how much work does the auditor have to do. So then after we figure all this out, then the next step would be to develop the audit procedures. So in the case of this first audit, we'll have to develop a lot more audit procedures. In the second audit, we don't have to do as much work because our inherent risk and control risk is low. So there isn't too much of a risk that there's going to be a material misstatement. So we don't have to dig into every single invoice and everything. But for the first one, we do have to look at a lot of stuff because there is a high risk that there could be a material misstatement in the financial statements. All right, so that is chapter 6. Thank you for listening and take care.